Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his Sunday expert, Mr. Dan Bird. How you doing, sir?
Pretty good. How are you?
I'm doing well, man. So last week we had the CPI number, which was the most important day or metric of the week. We also got the bonus of consumer sentiment collapsing to the lowest on record. That brings up Wednesday. We have the Fed meeting, the Fed release of their Fed funds rate decisions. I have my opinions on what I think they will do. I have my hopes for what they will do, but Wednesday could change the market. And let's talk about it. Where might this pain end if we get rug pulled on Wednesday?
Yeah. So here's my newsletter, first of all. If anyone wants to be added to it, just send me an email to breakpointtrading@gmail.com. You're welcome to include any thoughts about these interviews that you and I have.
Yeah.
Or just give me your email and I'll add you to the list. And if you don't like it or get tired of it or stop reading it, whatever, or don't like the cartoons.
Yeah. I don't know if you actually go
know.
back and look at the comments, but there's a lot of people that have become a big fan of yours. You quickly grew to one of the fan favorites. A lot of people are in the market. I'm glad we do this. You're helping me learn and you're helping a lot of others. So Dan, thank you for an hour on Sunday.
Yeah, that's a good point. I'm gonna have a comment about that. Actually, I don't normally go back and read the comments because this is just really mostly between you and me.
Sure.
Sometimes I do, though. I went back, I think last week, and read a few of them, and I'm gonna have something to say about a few of those in a minute.
Uh-oh. Okay. I'm nervous. I'm gonna go look which ones it might be. Go ahead.
You'll know.
Oh, okay. All right.
All right. So anyway, let's talk about where the market is and where we might be headed. Consumer sentiment we talked about last time. Terrible.
All
right. This is what the chart looks like right now. Now, just to refresh everyone's memory, this is my head and shoulders chart that I basically created the head, the shoulder, and as the market started to roll over, I created the right shoulder over here back in February.
Okay.
And I said at the time, and this is standard technical technical analysis, the distance from the head to the neckline is where the support is down here, which is at 4,300. Okay. The distance from the head to the neckline should be the distance to the target. So from there to the target, which ended up at 38.50.
Right.
So I said way back here, the 38.50 looks like where we're headed and probably will overshoot and head somewhere in the neighborhood of 3,700 to 38.50.
Okay.
Now 38.50 was 20% from the high, which is the definition of a bear market.
Yep.
We went right down to 38.50.
Yep. Went
a little bit below it. Three different times, went right down into that area.
Sure.
And all three times bounced back to 3,900, which coincidentally is exactly where we ended on Friday.
Okay.
3,900. So that's a significant support area. And this is the time you don't, with any of these charts, they don't predict where the market is going. So don't use them as predictions, use them as risk management.
Okay.
And what that means is when it gets to a support level, it will either bounce from that level or it won't.
Okay.
All right. If it bounces, then from a risk management standpoint, that means you can probably start entering trades on the upside. If it doesn't hold and it breaks through, that means we're probably headed much lower.
I got it. Okay.
But you don't anticipate it. You don't say, oh, there's a support level, so it's going to bounce. No, that's not what it's there for.
Got it.
It's there to watch to see what it actually does.
Interesting.
So you want to follow the trend. You don't want to try to be ahead of the trend.
Yeah, and this is a big deal because just like you called 38.50 and it stood the test of time a couple of weeks ago, that's because all the Wall Street guys are doing this. And I sent you a video of somebody on CNBC.
Yeah, I'm going to talk about that. I'm going to talk about that video here in a second.
Oh, okay.
And that's when I'll talk about some of the comments from your YouTube channel. But yes, that's exactly right. All of the big ones are looking at it. Yeah. In fact, I'll talk about it now. A couple of the comments were, well, these charts don't mean anything. Charts don't make any sense.
Yeah.
The big institutions and the big traders and the hedge funds, they don't do that. They don't use charts.
Oh.
They all use fundamentals. Well, that's not true.
Not true.
That is absolutely not true. That's someone that has not done their homework.
Correct.
And that video that you sent me, which I put a link in my newsletter.
Yeah, it was really good. Yeah.
that video you sent me was really good. The first thing they started talking about was secular bull markets.
You got it.
And that we are in a cyclical bear market.
Yep.
All right. Now, this is a person from a large institution that was talking about this.
Yeah, I think it
and
was
she was using all technical analysis jargon.
I think it was Morgan Stanley, but I may be
Morgan. I think it was Morgan Stanley. Yeah. All right. So some of the things she said, and I tried to reiterate it in my newsletter, and that's why I included the link. But she talked about the 38.15 level. She talked about 40.90 as short term for last week. Now, the video came out on Tuesday, so it was before
correct
the Thursday, market decline, and then the report on Friday.
Correct.
But she called some numbers out. She said 38.15 is a critical level. Now that's very close to 38.50, right? Sure. 38.50 is 20%, which is the bear market. She said 38.15 was the next level, and we probably won't hold it.
Yeah.
And she explained it in the video, but if you don't understand Fibonacci levels,
correct, then
you probably couldn't visualize what she was talking about. So she said the first Fibonacci level was at 38.15. Fibonacci was a scientist who discovered a numerical pattern in nature. It's in everything. And Fibonacci numbers are well known. Fibonacci levels are a staple of any technical analysis person. So they're going to look at these all the time. The way this works and the way that she was using it is she took the high, the recent high in January, which was 48.18. That's up here. And the low from the COVID crash, which is 21.91 down here.
Okay.
And all you do is you just drag the line from the top to the bottom, and it automatically calculates the Fibonacci levels.
Interesting. So yeah,
okay.
I didn't understand that. Now I get it.
So the first one she talked about was 38.15. That's a 61.8% Fibonacci level. That is a very important one. It's one that all traders watch. And back to the comments, yes, all of the big institutions do watch technical analysis.
And again, they're not front running it. They're looking to see, does it hold or do you go through it? That's the key.
That's right. That's exactly right. Now, when it held back in here, they all bought and we got the rally. So that's, back to the algorithms. All the algorithms were set that if it doesn't break through and it starts to go back up again, then start buying, which it did. All right, then it went back down, and now we're at that level again. We're at the decision point again. Now, she said she doesn't think it will hold. I don't think it's going to hold either.
No.
Especially if we get 75 or 100 basis points.
Well, let's be, I always like to look ahead. So I don't think it holds Monday or Tuesday, let alone Wednesday.
Yeah, no, you're right. I think Monday is going to continue. The market ended at the low on Friday.
Oh, it's coming.
Which means if the market had been open longer, it would have gone lower.
Yep.
So Monday is probably going to go lower.
Yeah. So I don't think it holds. And then if we get rug pulled Wednesday, Wednesday afternoon could be the bloodiest day I've ever seen other than the 87.
Right. So they asked her, so where does it end?
Yeah, they did. They asked her.
Where's it going to end? She goes, well, the
the
next interim level is at 3,500. She said 3,500. She didn't say that that's the 50% Fibonacci, which is right here. You see it's 3,505.
Yeah.
So the next level is at 3,500. It also happens to be where the 200-week moving average is.
Yeah.
She said the next interim level is at 3,500.
Okay.
And if it breaks through that, and she said that's a weak support. If it breaks through that, then the next one and probably the final one is 3,200. So 3,500, when she said interim level, that's the 50% point. 50% is not a Fibonacci number.
Correct.
But it is a psychological area. 50% is a psychological area where a lot of traders will come back in and a lot of time acts as support.
Okay.
So we probably will go down to 3,500 and then bounce sideways for a little while. And then if we continue going down, 3,200 is the next Fibonacci level. That's the 38.2. That's right down here. And that's why she said 3,200 was probably where we're going to.
Yeah. So I've had a lot of questions on my channel the last couple of weeks because I've been telling them I'm in cash, even though you and I you're helping me learn all of this. I've talked about a shopping list and people are like, well, when do you go shopping? So actually, you brought us these numbers 2 weeks ago, I think 35 and 3,200. For me, the answer is I might start nibbling at 3,500,
Right.
but I would likely put, I don't know, I would probably put only 10 or 15% of my capital that I've got allocated to this to work at 35. I would probably put 40 or more at 3,200. That's the number I've told myself.
Yeah, and I think the way to do that is as you're looking at different companies and putting together a shopping list, put it together based on companies that have real products.
Yes, real products, real earnings, maybe some dividends.
Real earnings, positive cash flow.
Correct.
Look for strong companies, and especially look for companies that are not declining or have better relative strength.
Yeah.
So
cheap. How many people are looking at cheap stocks? I mean, how many times people ask me about Peloton? Peloton is a clothes hanger and may get bought here soon.
That's right. It might not even be a company anymore.
Exactly.
So those are the kinds of things to look at and start adding to your shopping list. I actually put in my newsletter, I'm going to share this because it's relevant to what we're talking about.
Okay.
I put in a what's called a relative rotation graph.
Oh, you did. I don't remember that one.
Yeah, they're interesting graphs. A lot of people don't really understand what they mean, but
oh yeah, I remember this.
Let me do this. So relative rotation is just taking all the stocks. In this case, it's taking the sectors in the S&P and looking at their relative rotation. And the way it works is it's based on the SPY or the S&P right here.
Yep.
So the point right in the very center is the S&P.
Right.
And everything else is relative to that.
Understood.
Okay. There's the x-axis across the bottom is the relative strength. So how strong is this sector versus the S&P?
So XLE, I'm going to guess, is energy.
Energy. That's right. This is energy over here. So you can see from a relative strength, it is stronger than all of the other sectors. It's way stronger than all of the other sectors.
And is XLC tech?
XLC is communications. That's things like Facebook.
Oh, okay.
All right. XLK down here is tech.
Got it. Okay.
Now the y-axis is momentum. So the x-axis is relative strength versus the other ones. And the y-axis is the momentum. How fast is it getting stronger than the other ones?
Got it.
And you can see up here, this is actually on a 16-week view. You can see energy was increasing its momentum and its relative strength. And then it started losing momentum versus the other ones. You can see technology started coming up.
Right.
But now it's going back again. Now it's got an even better relative strength than it had when it started this decline. And it's heading back up in momentum. All right.
I got you.
And these other ones over here, you can see technology is actually in the lagging quadrant.
Yeah.
But it's moving up towards the improving quadrant.
Okay.
So we'll see, what that looks like as we go forward. And then down here, it just shows you all the sectors and whether they're outperforming or underperforming the S&P. And then what I did was I took the energy sector itself.
Oh, look at
that. Broke that down by the members that are in that S&P sector.
Buffett bought Oxy, right?
Yeah, here's Oxy.
Yeah.
So Oxy had huge relative strength. So that was the strongest stock of all of the ones in the energy sector. But it's losing momentum rapidly.
Well, yeah, I mean, that's the Buffett effect.
The ones that are gaining relative strength and gaining momentum is Valero, and this one here, which is Coterra. These two. So this is one way that you can take a look at sectors that are outperforming, and then look at the stocks in the sectors to see which ones are outperforming. To start to build your shopping list.
Yeah, well, one thing I want to ask, if you're not set up for it, no big deal, but I'd like to go look at Kathy Wood's portfolio because she was calling for a Fed pivot in July. She thought we had peak inflation and she was making a big bet. And she said that the Fed's going to pivot in July. I don't see that happening.
I don't think it's going to happen in July. No. One more thing before I jump over to Kathy Woods is something that's curious, and this is in the context of, when's it going to end?
Mm.
Something that's curious that I mentioned last time is, even though this last low that we had in May, we did not have a high in the VIX.
Mm-hmm.
Normally, if the market's going down, the VIX is going up. So if
Oh.
the market's hitting a new low, the VIX should be hitting a new high.
Here's my prediction for you. If the Fed rug pulls 100 basis points on Wednesday, you're going to get your VIX peak.
Yes, that's right. And that's the point I want to make with this.
Yeah.
So even as we hit this low right here, and if we follow that low back to this point back here and follow that down to where the VIX was, the VIX should be up here around 35. But instead it's around 28.
Wait till Wednesday.
So here's why I show this.
Yep.
In order for us to get to the bottom and make a bottom, we need capitulation.
Amen.
We need people to say, I am done. I'm out of this market. I am not trading stocks anymore.
Exactly.
That's it. The only way we can get that is for a VIX to spike up around 40.
Correct.
So yes, if the Fed surprises, that might just do it.
May just do it. Yeah.
That might just get us to 40 on the VIX,
Yep.
which would actually be a good thing.
Well, yeah, it would feel horrible for a couple of days, but yes, I think it would be a cleansing process.
It's counterintuitive.
Yes, absolutely.
So let's look at Kathy's down 35%.
Oh, that's not bad. I expected worse. Oh my God, look at all that red.
There's only one green one.
Ooh,
CRISPR Therapeutics.
I don't even know what that is.
Whatever that is.
I don't even know.
Now keep in mind, this is as of February 18th when I did this.
Correct. Yeah.
So she may have sold or added some
it's
positions here. I'm not sure. I'd have to go back and look at what she's got in there now.
It's just fun to look at. That's fine.
Right.
Because again, if she was right, if there was a Fed pivot in July and we had peak inflation, she would not be down 35%. It would be some number better than that.
Well, we won't, just like we talked about in the last one, we won't have a trend confirmation in July.
No, not anymore. I'm just saying
we will only have one more data point.
No,
even if it goes down.
Yeah. No, she called that before the results of Friday. She was thinking CPI would be, anyways. I just want to track this every once in a while because it's there's a lot of buy the dip fans that follow Kathy Wood, and I think there's a lot of companies in this list that won't exist in a year.
Well, she's dipping.
Yeah, there you go. All right, man. This has been a lot of fun. One more time, flash your newsletter for folks that should get it every week, please.
Yeah, let me see if. Oh no, there's one more thing I need to talk about here.
Oh, please.
Sorry, because we touched on recession. So I want to talk about recession.
Okay.
But in order to do that, I want to bring this chart up again. We talked about last week. The basis for most of my thesis is that we're in a secular bull market.
Correct.
And that video that you sent me that I included in the newsletter, that they started off talking with that woman from Morgan Stanley saying, you've said before that we are in a secular bull market and this is just a cyclical bear.
Correct.
Inside the secular bull. Now she also said it may go to 3,200.
Correct.
Right. But it's still a cyclical bear. As bad as it might feel, we are still in a secular bull market.
Yeah, I think I asked you one time 3 weeks ago how far it would have to go, and I think you said like 2,800 or something.
Yeah, it's right around 3,000.
Yeah,
because that number moves up as we go along, so it's probably gonna be around 3,000. Okay. It has to close below 3,000 to break this secular bull market.
Okay, all right.
Now, recessions, and you touched on recessions, and you looked back at all the recessions from before. And this was in my newsletter as well. And I talked about before that we are in a secular bull market. So yes, we could have a recession, but it probably won't be a prolonged recession. All right. Or your sense was that it was going to be a prolonged recession.
I do believe that, yes.
So an average length is 11 months for recession. If you include the Great Depression, it's 14 months. So that's the average length. And last time when we talked about this, I said I didn't mark where the secular bulls and the secular bears were, but I went back and did that.
Oh, okay.
So on this chart, these are all bear markets. All of these dates are bear markets. Some of them had recessions. That's this middle column.
Okay.
And some of them didn't. They were just bear markets. But based on this chart, you can see the secular bulls last about 18 to 20 years.
Mm-hmm.
And then the secular bears are in the red. So I went back and marked them on here.
Oh, okay.
So which of these bear markets were in secular bulls, and what were the recessions that occurred inside of those cyclical bears
Got it.
that occurred inside of a secular bull?
Yeah. So you're basically validating your thoughts that if we are in a secular bull, we have a short recession. That's what this highlights.
That's right. Exactly.
Yeah.
So this secular bull right here, we had a recession in 1990. It was 8 months long.
Right.
Secular bull here in the 50s, we had a recession.
Yeah.
By the way, we had 2 other bear markets with no recessions.
Mm-hmm.
Same up here. We had 2 other bear markets with no recessions.
Yeah.
But this recession lasted 8 months. This one here, of course, the COVID was only 2 months.
Yeah.
All right. But if you look at the secular bear markets, which
Yeah.
are these red boxes here,
Much longer.
right, much longer, 16, 16, 11, 18, 13, 43 months for the Great
Sheesh.
Depression,
Yeah.
right? So again, this just highlights, and then I put some definitions because we've had people ask before, what does it mean to be secular
Okay.
versus a cyclical? And these definitions in the top part up here are directly from Investopedia,
Mhm.
which is a great place to get definitions from.
Very
So
good.
secular market is over a long period. It rises or falls over a long period. Cyclical market is a shorter in duration.
Mhm.
All right, so the dates over here on the right are all bear markets,
Mhm.
but those highlighted in green are cyclical bear markets inside of their associated secular bull markets.
Got it.
Note the length of the recessions in the green secular bull section, circle
Yep.
blue. You can also, by the way, note the amount of decline.
Mhm.
Just because you have a short recession doesn't mean it doesn't go down as much,
Correct.
right? So this particular one in 87 went down 36%, but there was never a recession.
Yeah.
Right? The 2-month recession during COVID went down 35%.
Correct.
So just because it's a short recession does not mean the market is not going to decline by quite a bit.
Mm-hmm.
It'll just be a shorter period.
I got you. Very cool.
Okay.
Man, folks, you need to get this newsletter. A lot in there. Go ahead.
Yeah. Yeah, this was in the newsletter as well.
Yep.
All right, here's the newsletter, breakpointtrading@gmail.com. Just send me a note and I'll add you to the list.
Very cool. These will be up tonight. Dan, thank you very much for your time.
If you see this week and you send me a note this week, I'll send you last week's newsletter to get you started.
Cool.
And then you'll be on the list for the next ones.
Oh, that's a very nice movie. Nice touch. Thanks, buddy. I appreciate you.
You bet.